Hi, I'm Dave Bodamer, Editorial Director for National Real Estate Investor. I'm here in Atlanta at the NBA Commercial Real Estate Finance Conference, and I'm here with Dan Fasulo, Managing Director with Real Capital Analytics. How's it going?
Good. Thanks for having me, David.
No problem.
Yep.
So, I guess your year numbers are out. What are you seeing?
Yeah, 2011 was a pretty good year. Did about $220 billion worth of property sales nationwide. That's all the property types.
Right.
The first half was great. We did see some changes towards the end of the year.
Okay.
Q4, which is usually the biggest quarter of the year, actually we saw sales transaction growth start to temper a little bit.
Okay.
A lot of that was due to some of the uncertainty that popped up over the summer. You had all the nonsense in Washington D.C. Obviously, the well-publicized troubles in Europe. Mm-hmm. A lot of investors, and obviously, here at the Bankers Association meeting, a lot of the lenders got nervous. And
right.
Whenever there's an uncertainty added to the marketplace, that's when things start to temper.
Sure.
Now, I should certainly caveat that we're not going backwards. It's just the momentum of transactions has tempered.
Right.
Yeah.
So, but any read so far in the first couple of months of 2012?
Yeah, I mean, that uncertainty is still there. We got the presidential election in the mix now. I think January's been a little better than we might have thought. I mean, we are, forecasting another increase in transaction activity for 2012.
Right.
Whether certain investors or owners want to or not, there's going to be, a lot of maturity type events this year where, something is going to have to happen. More lenders are going to be, selling some of the properties they've taken over in this cycle. And a lot of those maturities that are coming up are going to force some sort of a transaction. So we do think things will pick up throughout the year.
And that volume that you talked about for 2011, what is that? How does that compare historically? I know in the past you've often compared what our year looks like to a previous year. So.
2011 volume basically matched what we saw in 2004.
2004. Okay.
2004 wasn't a terrible year.
Yeah.
Yes, we're still far off the peak. We saw more than $500 billion worth of sales in 2007. That was a different time. The CMBS market had exploded. There was massive liquidity in the system. I think it's easy to argue that, at least for the institutional part of our world, we're back to a more normalized level of transaction activity.
Right. And for a couple of years, I know we've talked a lot about, core, Class A, primary markets, that stuff. Has really never had that much problem moving. And then we've had some activity in distress, and it's kind of like this barbell that we've talked about. So is that shape changing at all as we look at 2012?
Well, I mean, the major markets, your Manhattan and DC's got very expensive last year, right? And you could certainly argue that prices have started to level off a little bit.
Okay.
At some point, if cap rates keep falling, investors start to push back a little bit. So 2011 was a little different in this recovery so far, as we did see investors start to, basically spread their horizons and, start to look at secondary cities and buy properties in secondary cities like Atlanta and Chicago. And actually, that's where we saw the greatest cap rate compression in 2011 was in those kind of markets one notch below Manhattan and DC.
And property types, I mean, multifamily certainly has been the hottest for a long time, and looks to continue to be. But what's your outlook for the major food groups?
Well, multifamily has been a clear standout. We were talking about the National Multifamily Housing Council event and how it was standing room only. Apartments are certainly well ahead of the other sectors as far as recovery, not only on the investment side, but on the fundamental side. Rents are improving nationwide, occupancy levels are improving. You can't really say that about some of the other property sectors, where it's more a market by market type of scenario right now. But you know what? As multifamily has gotten really expensive, we're talking about a lender here who's complaining about 4 caps in Raleigh-Durham.
Wow.
You know what? and the spread between multifamily and the other sectors continues to increase, that's going to encourage capital to flow out to some of the other sectors.
Okay.
And we've already seen some major investors like a Blackstone make some macro bets in like the retail and industrial sectors. So,
sure. Yeah. And I mean, you made reference to potential red flags. Is there any one thing that you're more worried about than anything else, and looking at like what could potentially slow down this year?
Yeah, you know, I mean, I certainly worry about Europe. For as much as, you know, investors and lenders have had to underwrite political risk in the U.S., I think that's kind of coming to the end. I think there will be some clarity during the fall. It's not just about Obama, it's also about the Congress, which, you know, could shift to the Republican side, or at least this stalemate could continue, which everyone likes a stalemate in Washington for certain issues. But Europe keeps me up at night a little bit. If that were to blow up, you know, if anything we've seen over the last 10 years, the capital markets have become truly global. And you know what, when Europe coughs, you know, the CMBS market, the CMBS spreads blow out here in America, and it does, you know, trickle down to the rest of the market. So I worry about Europe. Besides that, I think you can argue that the worst is certainly over. Fundamentals for most markets are moving in the right direction, and you know, this CRE industry is a big ship. Once you get it moving in the right direction, it's really hard to turn it back the other way. So I'm pretty bullish going forward for the rest of the year.
Great. All right, well, thanks for coming by. And make sure to check out other videos in our coverage from MBA.